Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer.
The following episode is a replay of a Rise48 live webinar put on in partnership with Kelsey Dineen.
For those that don't know me personally, I'm Jeremy Dyer, the VP of Capital Formation, and I am joined here by Kelsey Dineen, the Director at Equity Trust Company. Again, we're here to talk about self-directed IRAs today. It's probably the number one question that we get as a real estate owner operator is, are there other creative ways to invest in your offerings, your real estate passive investments, other than using strictly cash? And the answer is yes, there is. And so here today, we're going to talk a little bit about how to really unlock your old 401k, your old IRA dollars, and really get to a point where you could feel more comfortable about how you're diversifying your portfolio outside of what I call Wall Street and into Main Street. And so we're really excited about this topic, this conversation today. Kelsey does a wonderful job presenting, and I'm really looking forward to having her go through the benefits and really the how-tos of unlocking old IRA and 401k dollars to passively invest in real estate investment offerings. So without further ado, Kelsey, I would like to turn the baton over to you now.
Oh, thanks, Jeremy. And I think I love the phrase that you use, getting out of Wall Street and into Main Street. I think that's such a nice way of summarizing, the need that people are trying to fulfill here. They're looking for opportunities outside of the stock market, outside of mutual funds, or maybe they're happy with what they've gotten in the stock market or mutual funds, but they're looking to diversify and they just want more options for retirement money and their wealth. And they want to do it in a tax efficient way, right? Keep it in a retirement fund, keep growing it, keep it tax sheltered. So I love that phrase. I think it resonates with a lot of people who are looking for alternate asset types, which again, ironically enough, that's what we call, a lot of the assets held here, alternative assets, right? So things outside stocks, bonds, mutual funds. So thanks so much. Talking a little bit about me, I am a CISP, a Certified IRA Services Professional. What that means is I specialize in the IRS code, what you can and cannot do in an IRA account. So let me see if I can move this screen here. Here we go. This is my information. Anybody attending the webinar today, you are more than welcome to shoot me a text. That's my direct number. You can call or text. There's my Calendly link on there if you want to schedule a one-on-one meeting with your specific questions. Also have my email on there. So I've been with Equity. I've been in the space and basically working for IRA, self-directed IRA custodians since January of 2010. So it's been years now. Really interesting space. I love seeing how people are learning, and it's growing aggressively where people want to allocate more of their retirement portfolios to private assets, especially things like real estate. Real estate is probably one of the most popular, if not the most popular asset classes that people are really looking to learn about and diversify into. So really exciting stuff. I love what I do, and that's why I've been doing it for so long. I'm on the institutional side of Equity Trust. So when you think of Equity Trust, I try to explain to people what I do. And I explain to them, I'm a custodian for self-directed retirement accounts. And they're like, custodian? What do you mean custodian? What that is think of us like a Schwab, Fidelity, Vanguard, E-Trade. Those are IRA custodians. They hold retirement funds. They custody your assets that you're investing in through your retirement fund. So Equity Trust is a custodian, just like a Schwab or Fidelity. But we're different because we're not a broker-dealer. We don't sell assets like stocks or bonds. So my particular division is the institutional services side. I get to work with great people like Rise48 and Jeremy here talking about, the process to raise money from investors like yourself using retirement funds. We work hand in hand to basically educate both you as the investor and, the investment sponsors like Jeremy on what the process looks like, how to do it efficiently, and really just how to make it a good overall experience for investors who want to allocate some retirement dollars to these projects. when people say, well, I've never heard of equity trust, but I've heard of Charles Schwab, I explain to them, we've got about 81 billion in assets under custody here. We're the largest self-directed custodian in the industry. We service, clients all over the nation. We've been recognized by Investopedia, Forbes, US News. I mean, we've got the accolades. It's just self-direction itself is such a niche thing still. Like, people are still learning about the ability to use retirement funds. So, when I talked about, Schwab, they're like, oh, I know Schwab, but I don't know equity. That's why a lot of folks have not learned that they have the ability to diversify, and self-direct is the term in the industry. Self-direct, you choose the investments and you can allocate them to private offerings. We've been in the business for over 50 years. And again, it's just an idea of like this service that's growing as people learn and educate themselves, maybe even their advisors or their CPAs, that, hey, I have this option, let's learn a little bit about it and see what we can do to diversify my retirement portfolio. So self-directed IRA, you're going to hear that term a lot today. When you hear self-directed, some people will say, well, Kelsey, I already have a self-directed IRA at Charles Schwab. I choose my own stocks or my own bonds in that portfolio. And I'll say, well, you know what? That is true. Schwab does offer a self-directed option where you choose your own stocks or bonds. But real self-direction is where you can do anything allowed by law. What does the IRS, what does the government allow in a retirement account as an investment? And true self-direction is not only can I pick my own investments, but I have the full range of investment options like real estate, like private, maybe it's private equity, maybe it's a debt fund, maybe it's venture capital. All of that, technically, the IRS allows in a retirement account, but you have to have a self-directed IRA at a custodian like Equity Trust that actually allows that. So yeah, very interesting. Self-directed, think of it as twofold. I pick my own investments, and the company that holds my IRA will allow me to allocate money to private assets. A Schwab, Fidelity, Vanguard, they're not going to fulfill that second piece. They're only going to offer stocks, bonds, mutual funds, the things that they sell as a broker dealer. So hopefully that makes sense to everybody. Now, specifically real estate, why isn't it tied? Why isn't it associated with retirement funds? Like, most people, when they think of my retirement portfolio, my 401k, my pension, my IRA, they default to thinking, oh, my stock portfolio, my brokerage account, right? So why don't people also associate things like real estate with retirement funds? The reason why is really the broker dealers of the world, the Schwabs, Fidelity, Vanguards. They have shaped public perception of what a retirement account can do. And obviously, they're laser focused on stocks, bonds, mutual funds. So real estate is unique. They cannot sell real estate. They're not involved in those products, so they don't offer it. So I've even had clients, call me and say, man, I wish I talked to you a year ago because there was a great real estate opportunity I really wanted to put money into. I had money sitting in my IRA at Schwab, Fidelity, Vanguard, and I really wanted to use it for this real estate investment. I had no idea this existed. So again, it's a lot of word of mouth. It's a lot of education. It's people like Jeremy and Rise48 bringing it up during investor relations calls, because your broker at Schwab or Fidelity, they're not going to offer this as an option. They don't want to lose your business, right? So it is very much something that you have to educate both yourself, maybe even a CPA, your broker, about this existing, and that this niche does help people who are looking to set up IRAs, keep it tax sheltered, and diversify. So again, it's all about marketing, right? And what those broker dealers have said you can and can't do.
Yeah, I just want to bring up one point. I'm glad that you mentioned that, Kelsey, because oftentimes we have investors that say, hey, I want to bypass, the self-directed IRA custodian. I want to invest in one of your future investment opportunities, directly from my, Vanguard account, Schwab account, Fidelity account. But correct me if I'm wrong, if they choose to go in that direction, the challenge is now that's a potential taxable event for them. Whereas if you keep the money in an IRA vehicle, like a self-directed IRA, there's no tax consequences for moving those funds from Vanguard, Fidelity, Schwab, et cetera, into their self-directed IRA account. Maybe you can speak to that a little bit more.
Yep, exactly correct, Jeremy. So when people say, you know what, I'm going to pull the money out of my IRA at Schwab, Fidelity, Vanguard, because I reached out to them in order to do the investment and they told me no. And they told me, hey, it's not possible. So some people get frustrated and they say, well, you know what, I'm just going to pull it out of the IRA and do it anyway. What happens is Schwab, Fidelity, Vanguard, because they will not agree to hold real estate in the IRA there, what they do is they code it as a distribution. They're saying to the government, hey, This investor is pulling money out of the IRA here, taking personal receipt of it, and then going out and doing something with it. We don't know because we're not involved, right? So even if the investor were to take that money out and invest it in a real estate deal and try to make the argument, hey, I invested it immediately, it doesn't matter. As far as the IRS is concerned, Charles Schwab, Fidelity, Vanguard said the money left your IRA account, went to you personally. It's now taxable regardless of whatever you do with it. So that's a big no-no. You never want to do that. The idea is what you're doing here is you're moving it from an IRA, from a 401k or a pension. It could be any type of retirement account out of Schwab, Fidelity, Vanguard. You're not taking it personally. You never touch the money. It goes straight from your old retirement account to the new IRA here at Equity Trust. And a lot of times, if it's an IRA to IRA movement, we pull it for you. We'll talk about the mechanics of that later and the different ways of funding IRAs. But Jeremy, that's a great point, is never, ever should people just pull the money out of a retirement account because it's going to become taxable and penalized. You have to use an IRA custodian and move it straight from one retirement account to another if you don't want to pay penalties, if you don't want to pay taxes. So that's a very important first step that everybody should be thinking about if they're looking at a deal that they want to get involved in.
Yeah, thank you, Kelsey. Appreciate that.
Yeah. So specifically real estate, I have people say, where does the government say I can even do this, right? I've never heard of it. My Charles Schwab broker or Fidelity broker has never heard of it. Where does the government say this is even allowed? And I always send them this snippet from the IRS website. So there's actually a frequently asked questions page on the IRS website. And there's language that specifically mentions real estate. It says, quote, IRA trustees, that's the Schwabs, Fidelities, Vanguards of the world, they're permitted to impose additional restrictions on investments. For example, because of administrative burdens, many IRA trustees do not permit IRA owners to invest IRA funds in real estate. IRA law does not prohibit investing in real estate, but trustees are not required to offer real estate as an option. So again, if somebody's questioning, I've never heard of this, where does it say you can do this? This is a great direct quote from the IRS saying you don't have to, any IRA can hold real estate, but the company that holds your IRA can restrict your options and tell you can't. So the government will allow it, the company you're with might not. So that's where it all boils down to. Why do I even have to move my money from Schwab or Fidelity? Why do I need Equity Trust? Because we're a trustee, we're an IRA custodian that allows real estate, and the IRS says it's allowed too. So you need to find that company that agrees to hold your IRA and allows real estate in it. So that's a great little snippet for anybody who has an advisor, a CPA, anyone really who's questioning, where does it say we can do this? All right. Now, besides having the opportunity to do it, why would you even be interested in using retirement funds? So the number one thing, besides tax benefits that I kind of mentioned already, is access to capital. So a lot of people say, Jeremy, I really like this project. It sounds like a great deal, but I don't want to drain my liquidity. Maybe I've already spent money on some personal projects or personal investments. I don't really have a lot left over to allocate to this project. Well, if you have retirement funds, if you have a pension, a 401k, a 403b, a 457, you have retirement funds, and that money is earmarked specifically for investing, right? You can't just pull it out and take it personally because you might get taxed on it if you're under, the retirement age. So this is a way to tap your liquidity. You have retirement funds. You could use those instead of draining your personal savings. So access to capital, that's number one probably for most people, is I have the money just sitting in a retirement account somewhere. I could use that instead of draining my savings. The other big advantage, and this is for a lot of high net worth folks, if you're a high net worth individual, you're really worried about tax implications of various investments. The IRA is a tax shelter. And people, seem to be surprised when I tell them this because they're like, well, what do you mean? There's no capital gains taxes. There's no depreciation or capture taxes. How does this work? The idea is that the IRA is a tax shelter, and it shelters you from all those taxes, just like your IRA at Charles Schwab does. So if you were to buy a stock or bond in your IRA at Schwab, it generates income. That income returns to your IRA tax sheltered. It doesn't tie through to you personally. Exact same idea with real estate in an IRA here. The IRA is the exact same type of IRA you'd have at a Schwab or Fidelity. Same rules, same tax protections. So when you invest in something like real estate, there's no capital gains tax because everything returns back to your IRA here tax sheltered. So the ability to protect themselves from taxes is really attractive to high net worth individuals because they're worried like the more money I invest and the more I get it, being active for me, it's a good problem to have, but I'm worried later down the line when I do my taxes for the year, is that going to push me in a higher bracket? Is it going to impact something that I didn't, foresee with my CPA? In an IRA, you don't have to worry because it doesn't pull through to you personally. It's in the bubble of the retirement account and you're sheltered from that. So the tax sheltered nature of an IRA is a huge draw for high net worth individuals. We talked about liquidity. Diversification is another big one. People maybe are getting a little nervous about the stock market or bonds, whatever it might be, whatever their current portfolio is. They're just looking for the option maybe to diversify a bit. And when they find a great project that they really want to put money into, they can now pull a piece of their retirement account and diversify into some real estate or some other assets. And keep in mind, it's not all or nothing. You don't have to pull over your entire retirement fund. You can earmark just a piece of that money, pull it over to an IRA here and put that in the private, real estate project. Funny enough, that is another big question that I get. I think we'll talk about that later as well. But again, you can allocate as much as you want, pull that over, and diversify just that piece of your retirement account. Hold time. Another great thing for retirement accounts is the idea is you're not touching this money immediately, right? You're saving it, you're compounding it, you're growing it. You're not pulling it out immediately and taking it personally. So for investments that are maybe longer term holds, right? In a retirement account, that's perfect because I can't touch the money anyway, usually until I'm 59 and a half, which is retirement age. So IRAs are also very well suited for illiquid investments with long time horizons, just things that you might have a longer hold time that if I was investing personal money, I might need that in a year or two to pay some personal expenses versus in an IRA, I'm not worried about it. I could have a really long timeline and keep it locked up for as long as I want because I'm not worried. I'm not going to touch it until I'm 59 and a half anyway. So all great reasons. Yeah, the IRAs are pretty well suited to investments like that.
Yeah, those are all fantastic points. And I'm glad that you brought up the point about not having to self-direct your entire retirement account, right? You're really only self-directing the exact amount of dollars that you want to have, self-directed into, perhaps maybe one of Rise48's, future real estate investment offerings. So you might have a balance of 500K or $1 million, but maybe you only want to self-direct 50K or 100K, of that because you're seeking, diversification outside of Wall Street and into Main Street. And quite frankly, we have a lot of investors, they don't really own real estate outside of the home that maybe they live in, right? And so this really allows them to really kind of, diversify, their holdings. And maybe they want to get involved in real estate investing because they know that it's a hard asset. It, pays consistent, cash flow through distributions, but maybe they lack the liquidity, cash in order to be able to do that, or just simply they want to rebalance their portfolio and take a little bit of the, maybe the chips off of the Wall Street table a little bit, if that makes sense.
Yeah, definitely. I mean, and some investors love stocks and bonds, and they've done well with them with their brokers. But again, the idea is that if all your eggs are in one basket, it makes people a little nervous, right? So they're looking at, okay, I don't have to pull everything out of the stock market. I can diversify just a certain amount into this project. And I liked your example of maybe you have, $1 million at Schwab and you'd pull over just 100, maybe 200 to put into a project. It's not like you're liquidating everything. You still have that IRA at Schwab doing stocks, bonds, or mutual funds with the 800,000 you left behind. It's just that 200,000 that you've pulled over to put into various real estate projects. So that's the piece that you've essentially diversified. So yeah, you can have it all essentially. You could do Wall Street and Main Street.
That's great. Thank you.
Now, I'm a visual learner, so when I talk about the tax sheltered nature and compounding effects, this is what I'm talking about. I mean, when you own assets outside of a retirement account, every time you make a sale, if there's gains, you're paying taxes. And when you pay taxes, you're essentially giving that money to the government, and there's less left in your pocket to reinvest. So the idea is when you're doing your investing through a tax sheltered account, you get this compounding effect. Every dollar you don't pay in taxes is reinvested to make more dollars. Those dollars make more dollars. Again, it's a compound, growth idea. So the tax sheltered nature of the IRA really helps, especially with long-term windows where you're like, I'm going to keep this money invested. Every dollar I save, I keep reinvesting. So that's what you want to see. You want to see tax deferred or completely tax sheltered in the case of Roth IRAs. growth. So everybody wants to be on the left side of this chart where it's just, compounding versus I make some money, I pay some money in taxes and lose it. I have less to reinvest. All right. So Jeremy, you had mentioned a great point where people might just go to a custodian and just pull money out because they want to participate in a project. So number one tip when investing using your IRA, you have to engage with an IRA custodian. There needs to be a new IRA set up ready to receive your money that you're pulling over from your old 401k or IRA at Schwab, Fidelity, Vanguard. So definitely make sure the first step is that you have an IRA set up ready to receive that money. You don't want to pay taxes on it. You don't want penalties. You need it to go straight from one retirement account to another. Next big tip is the investments are always made in the name of your IRA. So on subscription documents, on anything, it's going to list your IRA as the investor, never your name personally. And again, the idea is that your IRA is the one making the investment. This is an asset. When you look at your account statement here, it will be listed on your IRA statement as an investment because all the documents are filled out listing your IRA as the investor. Now, when your IRA makes that investment, what does that mean long term? It means long term, any income generated by the investment flows right back to the IRA here, tax sheltered. So that's the third tip. Any cash, any dividends, any income, everything is going to return right back to your IRA here to keep it tax sheltered. Now, I do have plenty of clients who make these investments and they live off of the cash flow. So let's say you do the investment in your IRA, it kicks off dividends or income or something of that nature. The money still has to return to your IRA here first because your IRA is the investor, right? The money that is left in the IRA is still tax sheltered. You only pay taxes on what you're pulling out of the IRA. So if you're going to live off of the income that your investments generate, it still flows back to the IRA here first. There's now cash in your IRA, and you just do what's called a distribution, where you tell us the exact amount that you want to pull out of your IRA and take personally. So maybe that's your retirement plan is you're living off the income flows that these investments generate. So everything always returns to the IRA here first. Once that cash is back in the IRA here, you can determine at that point what you want to do with it. Next important point, lead time. You always want to give yourself at least a couple weeks to set up the IRA and transfer over or rollover funds. It's not instantaneous. A lot of people think like with a Schwab or Fidelity, like a broker dealer, they use what's called an ACAT system where you've got securities that press of a button, securities can move between accounts. That's not the world that a self-directed account lives in. We do what are called non-ACAT transfers. This means we're not pulling over securities. There's no stocks or bonds that are moving to the new IRA here. We're doing cash transfers. So because of that, you want to give yourself at least, let's say 2 to 3 weeks to open up the IRA. We'll contact your old custodian. They're going to wire over cash. Once that cash is here, then we're doing the investment in your IRA here. So again, that takes a little bit of lead time. So make sure if you got a project you're interested in, even if you're not ready to transfer over yet, maybe you just want to get the IRA set up so you're ready to go when it does happen, that's still a great idea. Still open up the IRA. You can always wait to fund it later once you know exactly how much you're investing, but give yourself some lead time. Last big thing that I always tell people, if you want to roll over a employer plan from your current employer, most people think of 401ks, right? If it's your current employer and you're under age 59 and a half, that money is probably not mobile. And the reason why is because your employer sponsors your 401k plan. Your employer can basically lock up your money in that 401k plan until you either retire, hit retirement age, which is 59 and a half, or you leave the job. So most employer plans have to be from previous employers where you've left that job, they no longer call the shots, and you can roll it over to an IRA here. If you are retirement age, which is 59 and a half or older, generally your 401k will give you some rules where it's like, okay, you're old enough now that will allow you to diversify at least some of this. So usually once you hit retirement age, you get some more flexibility in your current employer's 401k. But for everybody out there who's saying, yeah, I got a huge 401k with my current employer, unfortunately, it's probably locked up. The only way to know for sure is to call your 401k admin person and ask them that question. You'd be asking for what's called a rollover, where you're rolling the money from the 401k to an IRA here. Okay, so we talked about what won't work, 401ks from your current employer being the biggest one. Another big question I get, Well, you say I can buy real estate. What if I just want to buy myself a home or a vacation home or something of that nature? Can I do that? Unfortunately, not. So the IRS has some pretty strict rules about buying real estate. It needs to be investment only. So that means no personal use. You're not even allowed to do what's called sweat equity, where you go into the property and work on it yourself. So a lot of IRAs become what are called passive investors because there's these restrictions from the IRS on how much you can be involved personally. So no personal use of the property, investment only, no sweat equity, you can't work on it yourself, and you can't transact with any prohibited parties. Prohibited parties are yourself, your spouse, up your family tree, like your parents or grandparents, and then down your family tree, yourself, your spouse, your children's spouses, grandchildren, etc. So anyone, yourself, your spouse, and those linear relatives, those are people who cannot do business with your IRA. What does not do business mean? It means your IRA cannot sell a property to them. It cannot buy property from them. It cannot hire them to work on the property. It can't pay them a realtor commission to buy or sell property. There's no transactions allowed between your IRA and those people. Now, the self-dealing is usually the biggest issue because people are like, well, I already own property. I'll just sell it to my IRA because I want it tax sheltered. Unfortunately, you can't do that, right? Your IRA needs to be the buyer from the very beginning. Anything you already own, it's too late. You cannot sell it to your IRA. So those are the rules that the government outlines to show that your real estate investments are truly investments and not self-dealing or personal assets you're using for a vacation or something like that. So when you think IRA, think there's a wall between me and my IRA. My IRA is its own entity going out doing arm's length investments into various investments, no personal use of those assets. Hopefully that makes sense.
Yeah, it does. And I was just going to say that arm's length thing is what I've heard a lot, in the business. It's really a relationship, type thing. So, that's why so many of our investors, will leverage their old, IRA or their 401k dollars to self-direct into our investment opportunities because they're not actively managing the day-to-day execution, of the business plan itself. They're merely passive investors. They're not active involved in the day-to-day. And that's why the self-directed IRA strategy, is such a powerful strategy for individual investors that would like to, seek that diversification and they want to invest, at least some or part of their old IRA dollars or 401k dollars into our investment opportunities.
Exactly. And because it is arm's length, they're not worried about breaking rules and getting hit by penalties or any sort of, because if they were to do something, like let's say they go, okay, I've educated myself, I know what the rules are, and they do something that's a prohibited transaction, the government isn't hiring, to my knowledge, IRS agents knocking on doors, asking questions. What they do is they just make the penalties so extremely high that if you break the rules, your IRA is fully distributed. Basically, everything's taxable. I think it's as of the first of the year when the prohibited transaction occurs. So if you were to try to basically do something personally and run afoul of those rules, the penalties are pretty large. So passive investing, where it's arm's length, you're not involved, it makes it a lot more black and white. It's very easy for the investor to know, okay, I'm not going to run afoul of any of those rules. All right. What's the process? When you know this is something you want to do, what are the first steps you take? The first one, just like we talked about, opening the IRA. Even if you don't know the exact dollar amount you're moving over, even if it's something where you're still looking for a project or getting to know like the due diligence period, that's fine. You can open up the IRA at any time. You don't have to have a method of funding where you're pulling over money yet. So open up the IRA. That is always step number one. Step number two, once you do know what you're planning to do, transfer over, roll over some retirement funds. This is where you basically reached out to us and you say, hey, Kelsey, here's my retirement account that I want to pull some money from. Can you help me do it? What's the process? And depending on where the money is coming from, we're going to guide you through that process. So again, give yourself about 2 to 3 weeks because that transfer section, the step two is what takes the amount of time. Step one is easy. You can open up an account in 10 minutes online. We'll have it open for you, the old retirement plan. That's what takes the 2 to 3 weeks. So give yourself some time once you are ready to pull over money. Once that money's here in your IRA, the very last step is the actual investment. That's where we figure out, what are you investing in? Do we have subscription documents? Like, let's make sure we know exactly what your IRA is looking to do so we can help you with that. And the idea is that we're going to help you with the investment document paperwork itself, listing your IRA as the investor, your IRA's tax ID, everything in the name of your IRA. Once you approve it, we then get your permission to wire out funds. So your IRA will then send a wire to fund the investment, and that investment becomes an asset in your IRA here. So it seems pretty simple. Step one, 1, 2, 3, but at the entire time we have to be communicating with you so we know timing, what you're looking to do, how much you're doing, all those things. Other great thing is we're communicating with like Jeremy and Rise. We want to make sure that they're aware too of where you're at in this process. So just think of it as like a collaboration. All of us are on a team together to help you through this process.
I advanced it for you.
Thank you. All right. If you want a direct line of contact, this is my information, and this is Mr. Tony Ramos. He's my dedicated onboarder. So again, you can call, text us. We have emails on there. We even have an online application link. So biggest thing I would say is we're at the institutional side of Equity Trust. If you're going to be working with us to set up your IRA, do make sure that you're contacting us and using our unique application. If you just go online and start Googling things and clicking on random links online, it's going to result in disaster because you're not going to be set up with us. So you want to make sure everything you're doing is through the dedicated team here that can guide you through it step by step. We call it white glove service, right? Because we know intimately who you are, what you're looking to do, any deadlines, all those things. So it makes it a really great process when you have a dedicated point of contact here to guide you through it.
Yeah, thanks, Kelsey. I'll keep moving us forward here.
Perfect. All right, so we're going to get into frequently asked questions. So first one, how long does it take to set up an IRA? What documents do I need? We talked a little bit about that. Give yourself about 2 to 3 weeks prior to your investment deadline, because the most time consuming thing is pulling over that money from your old IRA, 401k, pension, etc. When you set up the IRA online, it's pretty quick. It's a 10-minute process. Just make sure that you have maybe your beneficiaries information, just like any other IRA you might have set up in the past. You can essentially identify a beneficiary. If something were to happen to you, who inherits the IRA? So you want their information. You also want an old account statement showing where the money's coming from. So if you're transferring from an IRA at Schwab, have that Schwab IRA statement downloaded. We're going to ask you in the application, hey, do you want to fund the account right now? If so, what's the account number we're pulling the cash from? Where is it located? Upload a copy of your statement. So those are the two main things I would say: beneficiary information and your statement showing where the money's coming from.
Yeah, that makes total sense. And I just wanted to take this moment just to add another anecdote here. For self-directed IRA investors that choose to deploy IRA dollars into Rise48 investment opportunities, we do offer flexibility on the funding deadline because we know that it can take 2 to 3 weeks. So for those investors that want to unlock IRA dollars to partner with us on our investment opportunities, as long as you let us know that you're in process with Equity Trust, and having those dollars moved over, getting your account established, there is some flexibility on the back end in terms of when that funding deadline is, because we do know that it takes about 2 to 3 weeks to complete the process.
All right. Next question I get a lot: how much does it cost? So I always explain to people, we're not a broker dealer, so there's no commissions or expense ratios built into products. The way we make our money is just a flat fee. So when you open up the account, there's usually a $50 new account setup fee. When you do an investment, there's an annual asset fee to hold the investment within the IRA. So most people, when they're investing, let's say 100,000 plus, the $350 annual fee that we charge is actually of value compared to if you had it in a stock or a bond. Usually those expense ratios are much higher because it's a percentage of that number. So flat $350 annual asset fee, that is per asset. We also have a value base. So if you're going to be holding a lot of smaller assets in your account, we have option 1 or option 2, either the flat $350 per asset or a sliding scale. You can switch back and forth at any time. So if you do have any questions, let me know. I can send you a copy. We can talk about your particular scenario, how many different assets you want to hold, all those things, and kind of which one's best for you.
Yeah, and at some point it would be nice too, not on this webinar today, but you can speak to an investor about the expenses that they're paying currently today in their broker managed account is likely going to be significantly greater than the cost that they're paying, Equity Trust on an annual basis per investment.
Exactly correct. And the only other thing I would add is those fees can be debited from the extra cash in your account. What we see most people do is they're like, that's fantastic. Why would I pay those fees with after-tax dollars on my credit card when I just could have you debit the cash in my IRA? So a lot of folks, if they're investing, let's say 100,000, they'll usually move over maybe 101, 102 just to give themselves a little bit of a buffer left behind in the IRA after the investment is made. And that cash buffer left behind, we can debit it. So they're good for years at that point because we're just slowly debiting that leftover cash left over in their IRA, if that's how they want to handle it. You can always transfer over more money too in the future from your old IRA if you want to just increase the amount of cash in the account. So there's a number of ways that people can handle those fees. Okay. The next question I get is, how do I indicate it wants to be a self-directed account? Are there any penalties or taxes from moving it from my old brokerage account at a Schwab or Fidelity to the self-directed IRA at Equity? The answer is all the IRAs here are identical to an IRA at Schwab or Fidelity. The difference is what Equity Trust as your custodian allows you to use that money for. So a traditional IRA here, identical in the rules to a traditional IRA at Schwab. A Roth IRA here, identical to a Roth IRA at Schwab. The self-directed piece is that we as a custodian allow you to invest it in private assets. So there is no, on our application, you're not going to see a checkbox for self-directed. Every account here is self-directed because Equity Trust as an entire custodian allows every single account here to be self-directed. Are there any penalties from moving it? As long as you're moving it from retirement account to retirement account, there's no penalties, there's no taxes, the money never touches your hands. I think Jeremy brought that up earlier where he said people just go and take it out and then they get surprised that there's penalties. So the idea is that if you engage with us, you set up the IRA here, we're going to help you with the movement. There's no penalties or taxes because you're moving it straight from one retirement account to another. The only time you might be taxed is if you do what's called a Roth conversion. And a Roth conversion is where you're moving it from a before tax account to an after tax account. And that's a usually traditional IRA to Roth IRA movement. If you were to do that, then it is taxable because you're essentially paying the tax bill by doing a Roth conversion. If you move it just from traditional to traditional or Roth to Roth, you have nothing to worry about because you're not changing account types. All right. Another great question I get, depreciation losses. So people will say, well, hey, I was doing research and I really wanted to declare the depreciation on my personal income. Can I do that? The answer is no. The reason why is because, like we talked about, this IRA is the actual investor. So as far as your taxes are concerned, when you do an investment through your IRA, it's not you personally doing the investment. So there's nothing on your personal taxes that is reported from your IRA's activity. The IRA is the investor. Now, the IRA is already sheltered from capital gains tax. So there's no need for it to declare depreciation write-offs or losses. So no capital gains or losses in the IRA, therefore no depreciation losses to report because the IRA doesn't need them. So the IRA is a tax shelter. And essentially, it doesn't even have to worry about depreciation loss, declarations or anything of that nature.
Yep, I do mention that to people too all the time. The IRS is basically saying you can't have your cake and eat it too. This does bring up another question though that actually Mike has, so I'm going to throw this out there right now, and that is, does this mean that the investor will not receive an annual K-1?
Great question. So you will still get a K-1, but it's not in your name. The K-1 will list your IRA as the investor with your IRA's tax ID. So it's the same idea. Nothing has gone through to you personally. This is not going to impact your personal taxes in any way, shape, or form. Everything is reported in your IRA's name with the IRA's tax ID, and that includes your Schedule K-1. It will show your IRA's title, and that's usually, I think we have a FAQ here coming up on that. It'll show the IRA's title and the IRA's tax ID.
That's great. And thank you, Mike, for the question.
Okay. Do I have to report anything special to the IRS? No, you do not, because us as your IRA custodian, Equity Trust, we do all the tax filings on behalf of your IRA. So when you take distributions because you're living off the income, we do the proper filings for the Form 1099s. When you're making contributions, when you're rolling over money, we do the reporting for the Form 5498s. So we as your IRA custodian, just like Schwab would do, we do the tax reporting for the activity going on in your IRA. Now, I will say, if you engage in something that generates what's called UBIT, unrelated business income tax, if a project or investment that you place your IRA money into generates UBIT, it's your IRA paying the taxation. So again, it still doesn't go through to you personally. It's in your IRA's name. And if that does happen, usually that K-1 that you're getting will disclose that there's some sort of UBIT tax due. And if that happens, you just let us know and we can actually work with you to file the Form 990T. And that's again in your IRA's name, paid out of your IRA. So everything still stays in the shelter of your IRA.
Yeah, that's great, Kelsey. Good explanation. And along those same lines, Robert asks a great question, and the question is
Mm-hmm.
really this, and that is, so the SDIRA files tax returns independently of the beneficiary.
Correct. So if you want to call the beneficiary the account owner themselves, then yes, the IRA has its own tax ID, its own tax forms. Correct.
Great. We'll advance here.
All right. Now, this is the title I mentioned that you might see on your K1 or any other tax reporting done for your IRA. So the title of your IRA as the investor on all paperwork, any subscription documents, any K1s, it's always going to use this format. Equity Trust Company as custodian for benefit of your name and your IRA number. Same thing with a tax ID. Your tax ID number is always used on all of those subscription documents, K1 forms, everything. You will never use your social security number because none of these investments are your personal investments. All these investments are in the name of your IRA using your IRA's tax ID. All right. What sort of accounts can be rolled into an IRA? So if I want to do this, what are my options? Where can I pull money from? Any IRA will work. IRAs are always mobile because they're individual accounts. They're tied to you personally. It could be a SEP, a simple, a traditional, a Roth. Any type of IRA will work. You can move it to the exact same type of IRA here. So I gave the example before, traditional to traditional, Roth to Roth, SEP to SEP, simple to simple. You can open up the exact same type of IRA here and do a direct transfer where we're pulling money back and forth between an IRA you might have at Schwab or Fidelity to an IRA here. Qualified plans are another word for employer plans. So 401k, 457, thrift savings plan, 403b. My mother was a school teacher for decades, and she saved up quite a bit in her government retirement plan and her pension. And when she retired, she was like, you know what? I could roll this over. I could use this too. So government plans, any sort of employer plans, as long as they are mobile. And again, if it's with your current employer, it's probably locked up. But as soon as you leave, as soon as you change jobs, once you hit retirement age, that's usually when those plans can be rolled over. And then the last point I'll make is the multiple IRA accounts. People sometimes assume they can only have one IRA, and that's just not the case. You can have as many different IRAs as you'd like. The government really regulates just how much you contribute to those IRAs. So there's what's called contribution limits every year. And a contribution is how much money can I take out of my personal pocket and put into an IRA. That is capped. The government has very strict rules on how much you can contribute on an annual basis. The number of IRAs is not capped. Once that money is in a retirement account, you can move as much as you'd like between IRA to IRA. So again, I just want to repeat that so everybody understands. Once the money is in a retirement account, there is no limit to how much you can move between retirement account to a retirement account. All right. We talked about this quite a bit. So again, a former employer account, can only a former employer account be used, or can a current employer account like a 401k be used? So again, if you're currently working for your employer, it's probably locked up. But once you hit retirement age, once you change jobs, that's generally when it becomes mobile. Another caveat I will add, if you are self-employed, so you have maybe a 401k that you've set up for your business, you have more options now because you are your own boss. You are what's called the trustee of the 401k plan at that point. Generally, you as the trustee of the plan, you control it. You make the rules. You can usually call your 401k plan provider and opt for an option to make what's called in-service rollovers possible. So if you are self-employed, reach out to me, let me know. We can talk about if you currently have a retirement plan already set up for your business, but you do have some more options because you are your own employer. You can change the rules. If you're not self-employed and you're with an employer and you're still working, unfortunately, you don't have that level of control, so it's probably locked up. All right, can I use a Roth IRA and convert to self-directed? So like we talked about, a Roth IRA is just another type of IRA. You would open up a Roth IRA here. It is after tax, just like it is at Schwab or Fidelity. The Roth IRA rules are universal. You'd open up a Roth here, transfer money from your existing Roth at any broker dealer like Fidelity, Vanguard, wherever. You transfer it straight to your Roth IRA here. It's still after tax, and the Roth IRA here is self-directed. All the accounts here are self-directed. So you would just simply open up a Roth and transfer that money over. Do I have to move my entire retirement account? What if I only want to use a portion of it? We talked about this as well. So the government allows you to have multiple IRAs. When you open up the IRA with us, if you're just moving over a piece, we call that a partial transfer. And on our application, it will say there's two drop-down boxes. Are you doing a complete transfer of this entire account, or are you doing a partial transfer? And if so, what's the dollar amount we're pulling over? So if you're just moving over a piece, when you do our application, there'll be a transfer section and you say partial transfer. Here's the exact dollar amount I want pulled over. And that's the only amount we pull over. Everything else will still stay in that old retirement account. We're only pulling the amount that you tell us.
Yeah, that's great. And Fred actually asked kind of a related question, and that is, how many of our investors, leverage self-directed IRA versus cash? And it's about 15%, maybe 20%, depends on the deal and opportunity. We're a big fan of diversification, as well. So, we'll constantly, advise, investors, if you want to self-direct 100,000 or 200,000, maybe let's pick a couple of different, Rise 48 investment opportunities to get you some immediate diversification, within real estate as well.
All right. The next question is, do I have to contact my broker or liquidate my current account? So going back to that example of I'm just pulling over maybe 100,000 from my old retirement account, that 100,000 does have to be liquid. So if it's invested in stocks or bonds, we can't liquidate that for you, right? So what happens essentially is once you do our application and you tell us as part of that application, pull over 100,000 from my Charles Schwab account, the next step is you're going to contact your Schwab broker or go online if you use your, self-serve options, and you will make sure that you liquidate at least 100,000 worth of cash, worth of assets to cash. Once it's sitting in cash, we pull it for you. So that's the only piece additional beyond our application and the process that we outlined, the 1, 2, 3 easy steps. Liquidation is the only thing additional that you have to do outside of us. And that's usually with your broker or online on your current retirement account portfolio. You just want to make sure that you have some cash equivalents. It could be in a money market. It could be in, there's various products that usually a broker dealer offers that's basically like cash. If it's liquid, we can pull it right over. If for some reason you forget to do this part, happens all the time, we get a notification from your old custodian saying, we can't send you this money because it's invested right now. At that point, we reach out to you and we say, need to liquidate. Once it's liquid, let us know, and then we'll try to pull it over again. So do make sure if you're telling us to pull over a certain dollar amount that you go into your old retirement account, you liquidate, you free up that cash, because once it's sitting cash in that retirement account, we will pull it for you. You do not move it. You just simply convert it to cash. All right. And then I think this is probably the last one. Now that my IRA is set up and funded, what do I do now, right? I've got the IRA set up. I've moved over my money. I've got a retirement account just sitting with cash in there. How do I actually do the investment? The idea is we've been working with you this entire time, right? You've reached out to us. You had a dedicated team here that set up your account, pulled over your money. Hopefully, you've told us ahead of time, this is the project I'm looking to do. So what will happen is while we wait for that money to arrive, we're usually working with you and the project, the investment manager, sponsor, to say, hey, this is in process. We're getting it set up. Like Jeremy said, they give a certain leeway as far as timing goes to IRA investors. So if we're telling them ahead of time, hey, the IRA is here set up, we're just waiting on money, they know, that this money is coming and you have some flexibility. So once that money arrives, we're sending you pre-filled subscription documents listing your IRA as the investor with the IRA's tax ID. It's for that specific project that you've told us is what you're doing. You're going to get a DocuSign email from us. It's so simple. You just read it over, review the terms, make sure everything looks good. You'll click to sign. And then the very last thing you do after you click to sign is you call us and you say, hey, I just did my DocuSign. You should already have it back. This is my verbal approval to release the wire. Once we get those two things from you, we're good to go. We send out a wire and your IRA is now the investor. We'll sign all the documents as your IRA custodian. So that's important to note. You approve it. You're the boss, right? Once you approve it, we countersign. We actually sign off on the subscription documents too, saying your IRA is the investor. It's our signature on behalf of your IRA that's legally binding. So we put our signature on there, we wire out the money, and we send the fully signed documents to the investment sponsor to complete your IRA's investment. And at that point, you're good. The money's gone out. It's now registered in your IRA as an investment. We've signed the documents as well and sent them out. Everybody should have what they need at that point.
That's great. if you don't mind, I'm gonna throw a couple of Rise specific questions because I've gotten a lot of
Sure.
questions coming in relative to Rise 48 specifically. But one of the questions that people are asking is, as we send out monthly distributions, to them for their investments, if they're leveraging the self-directed IRA strategy, those distributions are not being sent directly to them as an individual in their own personal checking or savings account. Those distributions have to stay inside of the self-directed IRA itself. And so those monthly distributions and that profit participation split that we provide to investors that partner with us on our real estate deals, those funds go right back into your existing self-directed IRA account that you have set up with Equity Trust. The second question that I have gotten from a lot of investors is, well, Jeremy, when's your next deal? So please do reach out to anybody on the Rise 48 team, whether that's myself or any member of our staff, our team, and we'll certainly let you know what we have, currently available on investments that we're looking to partner with investors on, and would certainly love to at that point as well, get you connected with Kelsey and her team so that they can help facilitate the movement of those dollars from your existing IRA or 401k into one of our future investment offerings.
And the only thing I would add to that is if you do have any questions on rates of returns, anything specific to the investment, keep in mind my piece is the IRA piece. So I'm not aware of those details. We're not fiduciaries. We don't give tax advice, legal advice, investment advice. So if you have investment specific questions, go straight to Jeremy, go straight to the Rise team. I'm here to help you with the IRA piece. And unfortunately, I can't speak or do any due diligence for you. All of that has to be between you and Rise 48. So please reach out directly to Rise with all those questions.
Well, Kelsey, unless you have anything else to say, I've really appreciated the tremendous, value, that you've brought us today. I've got a number of people texting me and messaging me on the side saying that you provided tremendous value to us today. So we really thank you for that. And I really thank the breadth of participation that we have, as well for those that are participating in today's webinar. So really on behalf of the Rise 48 team and all of our investors and Kelsey and the Equity team, Equity Trust team, really appreciate everybody's participation today, and we look forward to catching up with you soon.
Thanks so much, Jeremy. It was awesome.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.